Good morning, everybody. Welcome to the Flow Show. Good morning to my two colleagues, Cayman and Stelios. How are you doing, guys?
Good morning, everybody.
Morning.
Everyone okay?
Very good.
Yeah.
How's your bank holiday? Did you watch
Yeah,
the
very
king,
good, mate.
the newly appointed king, newly crowned
His
king?
Majesty.
Sorry.
Yes, His Majesty, the King of the Universe.
Wow.
Yeah, it was all good. Good party over the weekend, which
Nice.
is the main thing. So, yeah, still got a bit of a sore head and a bit of a suntanned bonds, sunburnt bond.
Same thing here. I'm looking very English right now with my red curl.
It was quite good actually, because on the Saturday was terrible weather, and the Sunday it was lovely, and then it's gone crap again. So, all for the street party. We had beautiful weather, and it's as we say, it's reflected on our noggins. A couple of pink boys sitting here today. How about you, Stales? Your weekend, mate?
All good. Had our youngest daughter's birthday party, which was fun, and
very nice.
yeah, she turned 9 last week, and it was fun. It was all good. Weather's very good. Actually, not today, but overall, it's getting a lot better. But yeah,
Cool.
overall, not too shabby.
Is that a 9 going on 9 or a 9 going on 19?
Yeah, she has the how should I put it?
You want a sticky wicket? She's got a mother's trait. You get in trouble for that one.
Yeah, no, she's a piece of work, I tell you. Anyway, yeah. We love her.
Kids, yeah, cool. We love them as much as they're pains in the arses. Sometimes we love our kids.
Yeah.
Right. Well, away from kids and growing up, let's see what else is growing in the world. China's economy was growing apparently over yesterday or early hours of this morning. Exports up 8.5%, better than expected. Not quite as much as the 14.8% prior, but a big drop in imports, down 7.9%. Overall, it improved the trade balance in dollar terms there, but a bit of volatility in those numbers, obviously coming out of all the lockdown stuff. Now, Bloomberg wasn't sure what to make of it. They dropped a headline straight after saying China's exports rose in April in a boost to economic recovery. And then an hour later, they dropped a headline saying China export growth slows and imports plunge as the recovery wanes. So there's one news outlet who don't know what to make of the data.
Well, they'll delete the one that's wrong afterwards, right?
No doubt. But yeah, I had me scratching my head over that one this morning. Over to the Bank of Japan, and they had their March meeting minutes out. Several members said they must be vigilant to the risk that inflation may accelerate more than expected. Members agreed there was a very high uncertainty surrounding the economy. Several members said cost push price pressures might last longer than expected if global commodity prices rise more than projected. But a few members said that they saw the environment surrounding prices starting to shift. So pretty much in line with what we already knew from the Bank of Japan, but there's still increased talk about what inflation might do and uncertainty about whether it is going to come down as expected in the latter part of this year below that magic 2% number. Some members getting a bit cautious that it might not. We also got UIDA coming out in the early hours of the morning, talking about the policy review, saying that specific policy isn't in mind when they're going to conduct this review, and they will conduct monetary policy as needed during the review. So it's not going to be decided by this review what they do in monetary policy. And he did lob in a couple of, let's call them hawkish grenades. He said if the price target is met in a sustainable and stable manner, the BOJ will end YCC and then shrink its balance sheet. We are seeing some bright signs, including on inflation expectations. So a very, very subtle shift onto the what may happen if they start to tighten. Certainly a bit more than Kuroda, but it's not too far removed from what we've heard previously. On the data front, the services PMI in Japan last week came in at 55.4 versus 54.9 expected, and higher than the 55 prior. Now, we did also get some wage and spending data overnight as well. Household spending levels dropped year on year to went down 1.9%. It was expected to rise, so disappointing number there. Also down on the month where it was expected to gain. Overall wages for employers was up 0.8%, a slight miss on expectations. Overtime pay not up as high as expected, or as high as last month, coming at 1.1%. However, real cash earnings or real wage earnings was down 2.9% year on year for the 12th month on the trot, showing negative wages. And that's the fight that Kishida has on his hands, as we've known recently, talking about wanting to get wages higher. They want to narrow that gap between real cash wages, which are running in the negative still. I'm not sure if we're going to start, or when we're going to start to see some of these wage negotiations that we heard about kicking in, and when we actually see that in the data. But those should be coming through at some point, one would think. Kay, what do you make of all that, including Ueda's lines there?
Yeah, so first of all, on your last comment, it should kick in starting April, because the fiscal year ends in March. So in next month numbers, we should in theory see the increases coming. So in that respect, we may kind of overlook what came out overnight, but the household spending is a big problem for whoever does conducts monetary policy over there, because the Japanese is always very, very reluctant. Now, this may also change in the new fiscal year. We saw that they hiked wages by what is it? Anywhere at 3.2 or 3.8. I think the average was 3.2, right?
So a bit high, 3.8.
Is it 3.8 the average?
I think it's 3.85.
Yeah, okay, 3.8, which is a bit over what the latest data showed on the or around where CPI is. So those numbers should come in a bit better starting next month in theory. But then on Ueda, yeah, it's still a give and take, right? If especially these numbers that we saw coming out don't start to go up and stay up, they will still have something to hide behind for not going too fast. On the other hand, he's still in this what we think is going to be the normalization process. It's going to be, as we said already, a bit slower than what the market may have expected a couple of months ago. But yeah, I think he's just keeping the options open. And I do expect, and we still have more than a month to go until the next Bank of Japan, and I do expect them to start talking about stuff a bit more concrete come the June meeting. The good thing for us, or perhaps the bad thing for volatility, but the good thing for the market is that he still communicates quite a bit, right? So that is something which seems that Ueda is not the kind of guy who is going to completely surprise the markets. There will be changes and shifts, but looking at the way he communicates, it should avoid big shocks. That is where we stand today, and that is, I think, also a bit reflected in the. We've had those big moves in the dollar yen, of course, after sending it up to 138 when they kept their hands completely still, and the market was questioning everything. But then now we start to see some stabilizing, right? And I have the impression that the rest of the currencies are going to have to do a bit of the heavy lifting on what's going to happen on the yen. I do think that it looks as if dollar yen is trying to stabilize here. Let's say, call it in the big range, 133, 136.7 or so. And that may actually be the range until the next Bank of Japan meeting, unless there's something shocking coming out in the rest, because we know we've got an extra labor report out of the US tomorrow, starting tomorrow, CPI, then another CPI before the next meeting. So a lot can happen on the dollar front, but in yen terms, I'm not saying he's going to be the new vol killer, but he does communicate enough to avoid bigger shocks, in my opinion.
Yeah, he's certainly not going heavy on the dovish side of things, keeping it a bit more broadly balanced in terms of what might happen. So yeah, I agree with that.
That is that's what we expected, right? We just need to know now the amplitude and the speed of how he's going to manage it. It seems very, very clear that the guy is going that his government, Bank of Japan government, is going to try to normalize, right? So that has not changed.
Yeah, exactly. It's just how they go about it and what speed and so on and so forth. And that, as we say, will be guided by the data, no doubt, which we'll keep a big eye on. Right, coming across to the Riksbank and more minutes out, and members noted that inflation is still far too high and far from the target of 2%. Members emphasised that there is considerable uncertainty and there is still a risk that inflation will become entrenched at a too high level. Several members raised the point that a stronger krona would be desirable in this situation. And Floden said that monetary policy needs to continue to be tightened, but that we are probably approaching the end point for rate rises. Was that a little bit of a nod to the currency there? Are we to expect gains to be limited?
They have been talking about the Swedish krona, right? They weren't happy about it, about the speed, sorry, at which it weakened. So yeah, they have been talking about it, but then saying that they're close to being at the end of the the hiking cycle is throwing the ball back a bit to the other side of the field. So yeah, in line with the rest of the euro crosses, the Stocky has also strengthened quite a bit. But if you look at where is it? I'm just trying to look at the same time where we are. In Noki Stocky has been coming off quite a bit lately as well, but then trying to stabilize now with the Norwegian krona rebound. But we're still trading at relatively low levels, so the Stocky is still a bit stronger than the Norwegian kroner. Yeah, I don't have a clear view on what really on what the market wants to do with the Swedish krona right now. What the Riksbank wants to do is one thing, but then just chatting about a currency is not going to move it for a long time. It moves it for a while, and then you come back somewhere where the market thinks it should be trading. And I really don't know about the Swedish krona. Really, I have no idea where the next 2 or 3% lie in that currency.
Yeah, I've been looking at it based on those comments, and they're no way similar to strength that someone like the PBOC or Chinese officials coming out and talking about the currency. They're nowhere near that sort of strength when the Riksbank to talk about it. But perhaps, you know, you could probably take that label off this chart here and slap euro whatever on it, and it all looks a similar picture. And maybe this might be one where those highs are going to remain pretty solid, and that's potentially the area to look at shorts if the Riksbank is going to jawbone the currency a bit more there. You've got a second wind that they want that done, and if the market's had enough of rallying the euro, then that's two winds blowing in one direction. But as Kay said, we've done quite a big chunk already, so remains to be seen if more is to come. But one to keep an eye on as far as they're concerned. Hopping across the border, we had the Norges central bank governor out saying there is substantial uncertainty about the outlook. The future policy rate path will depend on economic developments. Currency interventions to influence the crown is costly and not very effective. So they won't be intervening, well, none more so than what they do already with their NOK sales and whatnot over the oil. So they're going to continue that one. But again, you know, potentially what they do with policy could affect, as Kay says, the NOK SEK. So we may get a bit of a double win for that one as well. Kay, got anything on to add to that Norges stuff, or still? I know you've been watching the NOK particularly closely.
Yeah, no, I don't have anything to add. I mean, it's still something that's driven by the NOK. I mean, by Norges Bank, and the problem is that the more the currency stays weak, or the more it weakens, the more inflationary it is. So there's going to be some kind of reaction, I think, at some point. But yeah, I don't know. I mean, I want to sell the crap out of Norway, you know, euro Norway, dollar Norway, but I tried it once, failed, and I'm just biding my time now. Just watching. I'm not doing anything.
Yeah, I mean, on the tech front, you know, you could probably call that, give or take a few hundred pips, a bit of a double top up there. So anyone looking to trade it gives you a bit of a marker up there. Over that level, you're likely going to be seeing it up towards that 11 again in dollar NOK. But yeah, I think these ones are going to be pairs to keep an eye on. And as we know, K-Man and Still have a good all-round knowledge on those. So we'll be interested to hear what they have to say about those when looking at the charts. Coming up over a bit of other data, and Germany's industrial production wasn't looking too hot. When was that? I can't remember when it came out. Was that yesterday? There we go. Yep, German IP coming in down 3.4% there. So not good numbers for the Germans, but we know their Q1 growth isn't looking too hot, and they're potentially maybe one of the countries that are going to see a technical recession above the others, like France, Italy, and Spain, and the likes. So the data there is still not looking good. Eurozone Centix confidence fell 13.1 versus falling 7.5. So not a good number there. Investors still a little bit pessimistic over there. On the ECB front, ECB's not says rate hikes are working, but more are needed. ECB's Lane said there's still a lot of momentum in inflation. He's been rather hawkish of late, as a few of them have. ECB's Kazakhs, who's been a bit all over the shop the last week or so, says the ECB rate hiking may not be finished in July. Doing too little remains the greater danger. We still have quite some ground to cover, and that bets on a spring 2024 ECB cuts are significantly premature. It's not impossible for the ECB to hike or pause as the Fed cuts. So quite funny that even an ECB member is talking about Fed cuts, going against what Powell's been saying. Another hawk, ECB's Casimir, says the battle against inflation is far from won. Slowing hikes allows the ECB to go higher for longer, and there's plenty of ground left to cover. So those hawks flogging the rhetoric on that side of the fence. Over to the Fed, and Fed's Goolsbee says we must be data dependent and watch credit conditions. He's getting vibes that a credit squeeze is beginning. Too early to judge the rate decision for the June FOMC. Said that producer prices moved into deflationary environment. It should be extra attuned to issues in the bond market related to the debt limit. So a couple of things to pick from his comments. Firstly, tightening credit conditions is obviously something that Powell's spoken about, as have tons of other Fed members. Well, the Fed released their senior loan officer opinion survey, and that showed tighter credit and weaker business loan demand. And the share of banks that were tightening credit stood at 46% versus 44.8% prior. Now, looking through that report itself, it is showing widespread credit tightening, but perhaps not at levels that the Fed will be overly worried about just yet. But that's the type of stuff we need to keep an eye on now, as well as inflation. The Fed is all about these tightening conditions. So if we start seeing real big tightening coming in, that's going to have an effect on what the Fed decides. On the other side, the debt situation. And, you know, we can really look at areas where we can see that being priced. And one area, as one of our roomies pointed out, is the 1 month bonds yields. As you can see there, a big, massive jump up well into 5%, 5.6%. There was a very big auction last week, which shot rates up 5.8. It was trading. So this is the market worrying about the debt, because these are 1 month bonds. Okay, they cover, so they roll over the period when the US apparently can stop affording to pay, or won't be able to pay its obligations, which is around June the 1st, June the 4th, something like that. So this is the market saying we don't want to hold paper that runs over there, because that's the stuff that's going to potentially default first. So why would you hold stuff that's going to default? So we're seeing an exit out of this short-term stuff, and it's running into the 3 month bonds as well. And that money has been running into the longer durations, which is why we've seen 10 years pretty much going the opposite way and coming down of late. So that's, if you want to market snapshot of what's being traded around this debt stuff, that's what you need to look at. So any resolution, likely to see this 1 month yield coming all the way back down again.
Brian,
yeah.
Sorry to interrupt. If I may add something, I
Yeah,
don't know if you saw Bill Gross, ex-PIMCO, as everybody knows, was on an interview at Bloomberg TV, and he was talking about the debt ceiling, and he said, and I quote, "It's ridiculous. It always gets resolved." He did say it's not 100% chance, but he says, I think we can all assume it's going to get resolved. So for people who don't think that there's going to be an issue, buying 1 month bills is the way to go. So you know, he's a guy who's been around. He was CIO of PIMCO, so you know, few billion that he was running or more, and he's not concerned. And I have to admit, this is what I've been saying as well for the past days. You know, we've seen this movie 30 times in the past, 15 years. It always gets resolved in the end, because I don't think the US wants to default in any way. Of course, there's a lot of theatrics and shenanigans and negotiations behind the scenes, but does anybody want to be the reason, or does anybody want to see a default on their watch? Absolutely
exactly.
not. I mean, I don't see that happening,
especially the year before an election year.
Yeah, and if you ask me to put a percentage on a possibility of default, I would say quite a bit below 5%. It's not zero, but I think it's really, really low. So just my point of view, and what Bill Gross said is interesting.
Yeah, I agree with him. I might actually have a look today to see if I can trade any sort of contract on that.
Then you don't buy the 1 month, right? Because that's only up to the 9th or so of June. You will probably better be buying like 2 or 3 months.
Yeah.
Because they can take it into the 11th hour or so. I think that is like, as I was saying, because we've seen those pictures, right? They have been circulating for already a couple of weeks now, and the market is a bit panicky about it. But yeah, I mean, why would you hold the 1 month if it could go into July or so? So there's not much reason to hold the 1 month, right? And can I just say something about this report that you were talking about, the loan survey? Mm-hmm. Yeah, the credit conditions have tightened a bit, and they can still tighten more, but the positive that came out of there, and that I think is why the market is not acting too worried about that one now, is that the tightening, and there has been a mix of regional banks, of course, but the tightening was mainly due to Fed hiking rates and less to what is feared, that money is flowing out of all the regional banks. So that report is somewhat positive for risk, at least. So and I reckon that's why the market is relatively quiet, calm and quiet now, because there were some fears that would show some real nervousness on the banking sector, but it didn't really show it. So I think that's one of the positives to take out of the report, if any. Not sure that the market even traded much of it, but I think the reason why it's relatively quiet is there. If it would have shown something different, then we may have seen a much more nervous market this morning.
Yeah, rather than sort of positive news, it was not as bad as it might have been. I think we can call it that. But yeah, it is what the market's going to be watching. And I'm going to look into some of these contracts. I don't know if there's any rolling contracts or anything like that. But
yeah, the issue with all of this on this debt ceiling is that Yellen and well, especially Yellen, she's pushing the nervosity, because now I've seen that over the weekend or so, or late last week, she was calling CEOs of banks and things, talk about the catastrophe it would be if the debt ceiling wasn't raised. So she's trying to put pressure on the government in all possible ways. But if your head of treasury is acting so nervous, how can you expect the markets not to be nervous?
Yeah,
that is one of the reasons why we are here in those prices is because of Yellen.
Yeah, I was actually going to mention that she's really been ramping up, not just the weekend. She's pretty much nearly daily coming out with lines, threatening how bad it's going to be. And Kay's right, that gets investors panicking a bit. And we have come through a lot of these debt ceiling issues. I can't remember how long ago it was, but we actually had a time when it did shut the federal government down for a few weeks. But since then, this is probably over the last, I would say, 8-10 years, this has probably been the most worrisome the market has been about it. And that's all been drummed up by Yellen and the other players, and also by the banks. So let's face it, are going to be making a pretty penny, if not just on commissions, people getting in and out of various assets to protect themselves. So it's in their favour for there to be big market moves, and they won't be short in stoking those to earn a buck off it.
Ryan, I would argue that Janet Yellen coming out and speaking out and saying all these things about how bad it's going to be and all that, I would argue that this should actually make people feel a little bit more comfortable, because what are they trying to do? They want to push the debt ceiling higher, right? That's what they're going to do. So what do? They present to the people what a disaster it would be if this doesn't happen. So what do? They Yellen and everybody else, they come out, they start talking the talk and saying how awful it's going to be, and then they prepare everybody for when they do raise the debt ceiling. It's like, everything is saved now, we're good, everything is fine. So no need to worry, etc. So I don't know. It's a tricky kind of politics / communications game that they're playing. But at the end of the day, they have no option. They really have no option.
Exactly. And, to my point about the election next year, what a headline to run into it. We solved the last debt ceiling problem. That's a big boon for either party. But they're going to want to make sure that they get their piece of legislation in, or their part in whatever bill passes, so they can cry about it to the voters for next year. But this is all a completely manufactured situation, in my opinion. As I say, I haven't seen it this big in markets over the last 4 or 5 times we've had this debt ceiling issue popping up. But that's what it is. That's what market's going to do, and it gives us something to trade, hopefully. So we'll keep looking to see what we can pull out of that one. But if it does get resolved, then I would expect a bit of a risk rally in the US. Probably the dollar yen might have a run higher, yields will run higher again, and probably might be good for stocks as well. But we'll have to see what pulls out of that one. But staying on the debt ceiling front, and Biden will be meeting with congressional leaders apparently today at 4 o'clock Eastern Time US, which is around 9 o'clock here in the UK. So it's going to be after a lot of the market will be closed. We could be walking into some headlines that may happen during Asia that they'll pick up on. So keep an eye on that. If it's any positive headlines, look for, as I say, moves in risk that will start in Asia. And if it's big news, i.e. they've kicked the can for, I don't know, a year, 2 years or something, just watch out for the magnitude of moves. If they're not that big, it may be that when Europe and the US comes in, they then get magnified. But just keep an eye on that. Probably won't get anything of these first round of talks, apart from maybe that there was constructive views or something like that. Or it could go the other way, of course, and they come out of this meeting saying that no, they're still going to be bum fighting until the 11th hour, and then we see these yields jump in the short end and head back lower in the longer end. But tonight is the night for this meeting. And just one other bit of news on the geopolitics. There's a little bit of a spat developing between China and Canada, because Canada booted out a Chinese diplomat who has been accused of targeting a Canadian MP in a foreign meddling scheme. Wow, look at that, an FMS, foreign meddling scheme. Isn't that what governments do 24/7? But anyway, China retaliated by booting out some Canadian ambassadors over there. So that spat is picking up on that side as well. That's all I've got on the headline front. One other bit was the Russia V-Day Day celebrations, or V-Day celebrations. I keep getting that mixed up. Putin addressed the nation saying that how bad the war with the Ukraine is and how it's a Western puppet and all that sort of stuff. But there hasn't been too much out other than that. Not many tanks on display, apparently. Could have been blown up by the Ukrainians. Usually it's a big meeting, but it's been really scaled down at this moment. Anyway, that's it from the headline front for me. Guys, you got anything you want to share with the viewers?
Not in terms of headlines, no.
No.
Good. We shall move on then. So really today, or this week, we've got a few events coming up. Obviously, the big one that we're going to be waiting for is US CPI on Wednesday. Expectations are for headline CPI to come in unchanged at 5%. Just give you a look at the data calendar this week. The core is expected to dip a bit to 5.6 to 5.5 from 5.6 prior. Now, it's going to be the core number that's important in this CPI data on Wednesday, because that's the one that central banks are looking at now. So the headline, important as it is, will be second fiddle to the core number. So we could have headline dropping to 4%, but if the core rises to 5.8%, something like that, the market will go with that core number, not the headline number. So that's coming on Wednesday. Real lack of data, as we can often get the week after the Fed and the NFP. But on Thursday, we have CPI data from China, so just keep an eye on that one. And we have the BOE, and it's a bonus BOE because we have the monetary policy report. So that means a presser from Bailey, which means Kay's probably licking his chops at getting into some pound shorts on the back of Bailey speaking.
I'm actually long sterling right now, but you know, it's all about timing, right?
Yeah, exactly.
Buy it now and then come back on Thursday morning and sell the crap out of it.
Yeah, buy in May, sell on Bailey. And US PPI, which I think is also could be more important than the CPI data, because if that continues to show some big weakness, and we get some further disinflationary numbers, particularly year on year. We're seeing quite a bit of negative numbers on the months, but keep an eye. If we start to see some of these year on years turning negative, that's going to have a big play into future inflation numbers in a couple of months ahead. And we've already seen Spain showing a negative PPI year on year. that's going to be the big problem for central banks if inflation starts turning negative, because that means we're really undoing a lot of what we've done over the last 2 years. But for the moment, remember, lower gains are still gains. It still means prices are going up, just not as fast, and nowhere close to getting back to where we were before this inflation rocketed up. So yeah, I think that might be potentially more important than the CPI data when we get it on Wednesday. You got any early thoughts about the BOE, guys?
Yes.
Oh, here we go. Juicy.
Well, I read varying reports. There's arguments for both sides. So the BOE, what they do, they have a 2-year horizon, and they say, is our monetary policy good enough to bring inflation to our target within the next 2 years? That's a very difficult question to answer because we really don't know what's going to happen in the next 2 months, let alone 2 years. But there's a lot of people on the, I read analysis and listen to people talk about the BOA, and they're saying, a lot of people saying, well, on a 2-year horizon, I think they might say our job is done, and look at the US, inflation is dropping, so we should be done as well, and maybe we hike, I think it's done that they hike 25. I mean, that's without a doubt this week. But after that, what happens? So maybe they say, yeah, we do 25, then we pause and see how things progress. I find it very hard to see how a central bank with inflation up here, easily the highest inflation out of all the major economies, and not only the fact that it's high, it's that it's sticky. The US inflation was high as well, but then it started trending lower and lower and lower. UK inflation is just so sticky. So I find it very difficult how any reasonable central bank, given what we have today, would say that, hey, in 2 years' time, everything's going back to target. But having said all that, there's always a but. This is a Bank of England we're talking about. The Bank of England are notoriously dovish every chance they get. So I fear that given that the Fed is effectively paused now, this will ease the pressure on them and on other central banks, and that will make their job a little bit easier, their job being paused as quickly as we can. So what do I think should happen? I think they should hike 25 and do maybe 2 or 3 more, at least until you start seeing a trend going lower in inflation. But I fear they're going to do 25 and pause, which is madness in my opinion.
Yeah, you never know with these guys. There's always a case of what they should do, what they shouldn't do, and what they will do. I still think 5%, as I've been saying for probably nearly the best part of a year now, 5% is on the cards for UK rates. I agree with you. I think they should continue hiking. The votes are going to be important because we know there's at least 2 doves on the board, one of whom would happily cut rates now, even with inflation at these levels. So yeah, it's going to be a bit binary. If they indicate a pause, that's probably going to do quite a bit of damage to the pound. But conversely, if they a bit more hawkish than what the market's expecting, it could see the pound gain significantly. So keep an eye on your cable, keep an eye on your euro sterling, and we'll see it from there. Kay, you got any thoughts?
Yeah, I think I'm going to not go with the consensus view this time, and I think we get a hawkish report because the data have not been falling out of bed in the UK. Well, people know I've been much less bearish sterling for a while than I used to be. Just because UK seems to reset itself through all those strikes, all those. Of course, we can still get data worsening due to the strikes with a bit of a lag, but I think there is absolutely zero reason for them to be dovish this time, and we might get a little bit of a hawkish surprise. I'd rather have a hawkish 25 than a dovish 50 as well. That's the other side, because if they have to do 50, then we know what Bailey is going to do, right? He's going to talk it all under the carpet, and sterling may actually suffer in line with what we saw when RBNZ initially raised the 50 BPs. Kiwi shot up and then lost 2%. I'd rather have them do a hawkish 25, and that's going to do continue to underpin the sterling, in my opinion. But if they do their if Bailey does a usual Bailey, then yeah, I mean, sterling should be sideways at best, or perhaps even come off a little bit again. But I mean, there's no reason for them to be dovish this time. CPI is sticky, and the data are not falling out of bed. So I think it's we might for once be in with a meeting that could underpin sterling.
I agree. And Ryan's gone to sleep.
No, I'm here, mate. I'm here.
Oh, okay. No worries.
So, yeah, I agree with Kay there. I'll let him probably take a closer look at cable, which is currently holding that 126 handle again this morning. Euro sterling, another one to keep an eye on. We're down in that big low support area that we've been looking at for quite some time. So this is potentially maybe a little bit of a watershed moment. If we break here, we could
well breaking.
Be down.
We seem to be breaking on euro pound lower below support, but I always want to see what daily close we get. So
yeah, 86.90 is sort of my line in the sand for this part of the range, which is pretty much runs from there to sort of 87, 15, 20-ish. You know, you can see those prior lows there, but we've had previous action here at 86.90, so that's as I say, my line in the sand. Break there, we're probably going to hit this zone, and I wouldn't be surprised if we hit the lower end of that zone, 60s, 70s in the first instance. Under there, you know, we're talking about you know, down to the 40s, 30s, 20s, and we could get a run if we get below 86 all the way down to another decent support area around the 85, 50, 70 area again, which we saw in the latter part of last year. But you know, this pair is good for ranging, but it really can swing on what the Bank of England do. If I do see a move down there, I'm going to look for a long there. I'm still core long. I'm still core long, so I might decide to chop some out if we do get a big break. But my lower position is 86.20s. So I still got a bit of margin in that trade there. Guys, you can hear me okay? Because I'm not sure I've got a bit of internet problem over this side.
Yes, we can
hear you.
Yeah,
we hear you.
Good. Right, Kay, do you want to have a little look around?
Sure thing. And let's start with the sterling then, while we run it. Cable. As we saw the last week, the end of last week, Friday we broke above this little wedge, and this morning we were retesting it, and it seems to hold for the time being. We've got to give those things a few pips leeway, right? So I'd say that if to call this really a failure, okay, some people you might say as soon as we go below the figure, this is a failure, but then you've got those prior highs a little bit here, and then before going, I'd say if it goes back below 125.75, this may be over for this move. But for as long as we are in this kind of gradual move higher, there's no reason why not to expect that at one stage we are going to test somewhere around this 127. If you look at here, the 61.8 of the big move lower in 2021, 2022 is at 127.60. We did though on the other side, we did though reject this May 2022 high, which I highlighted in the room as well. So this is the next, let's say, level on the top side to watch. If we start to go below 125.75 again, I think then we are just going to range. And very possibly start to magnet this zone again in the mid 124s. I foresee much more of a range play. We're going to retest the lower end of this wedge perhaps. Yeah, for as long as it holds here, I'm relatively positive sterling. Now I'm looking at the dollar, and I'm not too inspired to be long cable for the time being. But yeah, it's holding that zone. It's actually a relatively easy and low risk trade if you wanna trade breaks that cable though. But yeah, I saw this on the euro sterling, and as coming to the euro sterling and more euro crosses, as people know, have listened here on F.A.C.E and in the room, I've been saying that I think we are going to hit tops on the ECB in the euro crosses, and then start to come off a bit again, and that's exactly what happened after the ECB. We did already see a move lower before the ECB, and that had to do with this big demand on the euro crosses that we saw at the end of last month, and then the setback. But then we had the move higher into the ECB, and then started to move lower. We were discussing how hawkish or dovish was the ECB hike. They're not done, but you don't always only look at interest rates, right? There's a lot of, and I think a lot of positioning was in the euro as well. And now we are seeing this positioning being partially at least undone. And then, as I have been saying for days, if not weeks, I really think sterling is showing, I call it elasticity, but like really good resilience and possibility to bounce from levels. So in a bit of this trade, I've been in since past the ECB, in and out, and I'm back in there. I think that 87 is a level, right? 87 is a level. Whether you look at it on the shorter term, but even the longer term trend or fibs as well, 87 is definitely a level on the euro sterling, and it's been a level here as well. We know how this traffic zone can slow things down, but we are trading bang on the level, and I would not exclude a move down to 80, low 86s, 85 possible. But okay, in the meantime, Ryan already showed some levels in between. 86.75 is already one, and then 86.40 is another one. And euro sterling is not usually such a fast mover, but it could. To me, it looks still weak enough to go and have a test a bit lower before the Bank of England, and then of course we have to take into account the impact that Mr. Bailey can have on the sterling. But as I said, I'm not expecting this BOE, or they shouldn't be dovish. That for the euro sterling. Sorry about that. Okay, let's look at the rest of those euro crosses and euro Canada. Okay, I haven't been writing this for long enough. Unfortunately, I did sell a bit of this break here, but I was out quite early because of this move here. But then together with the euro saying that we have moved enough, and the pretty sharp rebounds that we had on oil, and I don't know about gas lately, but I think it's been rebounding a bit as well overall. That's really helped the Canada. And then we had this again more than half decent labor report, albeit the biggest job creation was on the temporary jobs, not on the part-time jobs, not the full-time, but it was good enough to take it through support here. And now we are looking at the next bigger zone here. You've got 146.40s and 146.15-ish, 15.45. 146.15.45 is your zone to watch. If we get a stretch point, 145.75, but already below 146.15.45, I would say this is looking pretty weak. But again, as I said in the room as well this morning, We've had those overly long euro positions in the market, and they've been correcting themselves or rebalancing or reduced over the past sessions, especially post ECB, and also the euro crosses I think have been capped by this here. The triangular wedge or whatever you want to call it, 111 is a really is starting to be a real big level. I thought there would be a chance to go through it and have a test of the mid 111s, perhaps even 112, but we can't reach it. So the rejections of this 111 level, perhaps a little less stress on the dollar side of things, have also been weighing on the euro crosses. And you can look at any cross you like on the euro side. They're all quite a bit weaker since the end of April, starting of May. We're still early May, but look at it for the euro Kiwi. We are on support right here as well. Been really rejected quite strongly there. Back into the channel, and if we can get out of this channel a little bit like Euro Cat, why not go down in the 172s? But let's first see how we close around this channel. Euro Aussie, ditto.
Okay.
Yeah.
Just before we kick on, I'm getting some internet wobbles here, so I've just made you host in case I
okay.
Something.
All
okay?
right. Okay.
Make sure you pay your internet bills as well. Okay.
Euro Aussie did exactly the same thing. We had these blowouts through the wedge, then came back into the first one, came back into the second one, and actually I think it has helped Aussie dollar as such as well to rally. Is those crosses, those Aussie crosses starting to hold and do a bit of a reversal. But again, here we're back through the 164. We're on support here in the 162 zone, but if there's more to go on the correction, it could go all the way back down to 159. But that's still a 2% move from here. So I don't know. As I said in the room, I think those euro crosses, it was logic. This setback. I've been trading some of it. I've been trading the euro Noki as well. But we have to know that the ECB is still on an upward path in the rates more than possibly other central banks. So keep it into account. So basically my idea is, as we also saw the German rates, the German data weaken a bit, is that there's more corrective activity to be done on euro crosses, yes, but it may be more in time than actual price action, because we are coming to levels where the euro via the crosses could just hold. That's just my view on things. Euro Noki, I've been playing this one short as well. Took my profits this morning because we don't get to that 50-51 zone easily, and also looking with an eye on Brent, it looks to stabilize here as well. So I prefer to take the profit and then have a look on what's happening. So if you're interested in Norwegian kroner, we also had Raphael, one of our roommates, this morning saying that there is some budget talks in Norway that should be coming through on Thursday, which may show a little bit less Norwegian kroner to sell. That's the expectations of the Danish bank, maybe less Norwegian kroner to sell. So if that filters through in that budget, then we could have a test here of this euro Norway. Dollar Norway, same thing. I was short, but I cut most of it. Managed to grab most of it around this 1050, was short in the 1070s also. So that was a decent run. But there also we could not so far go to really test the real support around 1043. So prefer to take the safe option and cut it. So for the time being, that's it. Tomorrow, US CPI. Could it be enough? This dollar yen, could there be something like this building in dollar yen, and we come back down to low 134s, why not even 133s again? It's all possible, but let's see what the CPI brings tomorrow. In the meantime, I really think it's going to be more of a rangy market until then, because there's no like big dramas coming out data-wise or reports-wise, and the market pretty knows everything that's going on right now. So that's it for me. Ryan, if you're there, you can
Thank you.
Yeah, can take it back. Have a good day, everybody.
Yeah, thank you very much, mate. No, I think we'll leave that there. Still, you got anything you want to chuck up or put in, or if you want to
Not
save
really.
yourself?
I can have a look tomorrow at some charts.
Save you for CPI day.
Yeah.
No
Cool.
pressure. No
Thank you,
pressure.
Kay. That was really great, as always.
Yeah, thanks, mate. Thanks to both of you. And thanks to all our viewers for coming to the Flow Show. As always, your support is much appreciated. Have a great day's trading. We'll see you all tomorrow. Thank you very much.